Welcome to the Full Tracy Money Audio Commentary. This is Owen Tracy recording. It's 3:21 p.m. That is Central Time, and today is November 28th. Well, I think most of the action today was in the currency markets because the dollar is breaking lower. So this is the third consecutive week on the downside. In fact, it's 4 out of the last 5 weeks that have been on the downside. And this is obviously pricing in the potential that the Federal Reserve is at the top of their interest rate hiking cycle. So the Fed officials are about to go into their quiet period ahead of the next decision, and the Fed funds rate has basically been on pause now since July. So the length of period, or the lengthy pause that's already been underway is not quite as long as what we had in 2018. It is, I think, probably more comparable to the kind of move that we had in the period ahead of the financial crisis. What I think is rather interesting here, though, is that they've given a lot of telescoping because they first started pausing a little longer. So they've been easing into this peak. So that does beg the question, where's the trajectory of inflation likely to go? And then are we going to see unemployment continue to rise? One thing that is certainly true is that financial conditions continue to ease. So that, I think, is probably something that the Federal Reserve are probably going to be taking into account. That even just the slightest inclination that they are going to begin to stop raising rates or cut rates has resulted in financial conditions easing very precipitously all the way through November. So that's one way of looking at it. But I think it is important to also look at the longer term chart that we have here, because the more history we look at, we can see then that the the upper side of this range is around 100. And yes, we had a massive spike in 2008 and 9, but every time financial conditions have got up to around that 101 level, they've pulled back. But the last few times that it has done that, we've had very significant easing. And on this occasion, we had it go up to tight levels about a year ago, and then they came back down. And then subsequently, they've been coming down again. But we really do need to see it breaking lower if we're going to move back into a very financially easy kind of environment that really helped to stoke a lot of risk-taking behavior in stock markets. Of course, the other way of looking at that is to look at the Nasdaq and the speed with which it has rebounded over the last 5 weeks. And the index was in positive territory today, but it is pausing in the region of the 16,000 level. So on the one hand, we have the dollar that is rolling over in a really quite aggressive manner, and that is certainly helping to stoke interest in commodities, most particularly gold. Then you have the financial conditions that have been easing, and that is putting downward pressure on yields. So it's not just the long end of the curve now, but the 2-year yield is also starting to contract. And then, of course, it begs the question, are we going to see yields come back down, inflationary pressures dissipate entirely without, in fact, stopping, or without, in fact, going into negative territory, stopping above that bracket? And then subsequently corporate earnings surprise on the upside next year? Or will there be some sort of rockiness along the way?